Good evening. Welcome to the latest edition of TigerHawk TV, as usual, unedited. A little bit rehearsed, but definitely unedited. Our topic for this evening is the vexing question, why aren't the banks lending? What's keeping them back? This has already been the subject of some political controversy, and it's going to become a very hot topic in the next year if the banks don't start originating new loans. Neil Ferguson, in his excellent piece over the weekend, looking backward at the course of the year 2009, it was a speculative future history, if you will, hit this very point. He wrote a paragraph I'm going to read off my screen. There was an uproar when Timothy Geithner, U.S. Treasury Secretary, requested an additional $300 billion to provide further equity injections for Citigroup, Bank of America, and the 7 other big banks, just a week after imposing an agonizing mega merger on the automobile industry. The banks seem to enjoy an infinite claim on public funds, yet no amount of money seemed enough to persuade them to make new loans at lower rates. And this is, and then he imagines an indignant Michigan lawmaker complaining about this and how pathetically managed the banks are compared to the automobile companies and all the rest of it. So this is going to, I think, be an issue for the banks if they don't start lending. Well, why aren't they? The reason they're not lending, in short, is they can go out and buy high-quality loans on the market today that yield a higher rate of interest than they can get by originating new loans with new borrowers. So banks lend to corporate borrowers typically at a spread over the London interbank lending rate, LIBOR, and that spread today might be for a good credit that's not an investment grade company, 3 or 4 percentage points or 300 or 400 basis points over the prevailing LIBOR rate. That might make the loan 5 or 6% over 3 months, that kind of interest rate. It's possible, however, for banks to buy such loans, term loans from good credits, bearing a yield at a discount, which would then generate a yield of 700 to 800 basis points over LIBOR. So they can turn around and make more money by buying loans on the interbank market than they can possibly earn originating new loans, taking on new risk, and bearing the expense of running a new credit through their organization. And this is all in a climate where bankers are afraid to look stupid, and who wants to bring on a new credit that might go bad in such a risk-averse, paranoid climate. So the question then is, well, why is it possible to buy these loans at a lower rate? Excuse me, at a high, why is it possible to buy loans at a discount, generating a higher rate of interest than could be earned by originating new loans to new borrowers for new projects? The answer there is that there are a great many sellers who are in effect liquidating. A large part of the loan market, whether via term loans or through securities such as high-yield bonds, a great many of the participants in that market in the last few years weren't banks at all. They were either investment banks or other institutions that operated at a much higher level of leverage than banks do. So if banks had perhaps $11 in loans on their balance sheet for every dollar in equity, many of these other institutions had perhaps $30 in loans for every dollar in equity. And we let them do that because in theory their deposits weren't insured, and the taxpayer in theory wasn't standing behind these risks. Well, what's happened is that in the panic that ensued in late September and through October, many of these institutions were faced with huge pressure to liquidate, coming from, in some cases, investors who demanded their money back, and in other cases from other creditors who were in a position to either squeeze these institutions, or far more likely, the institutions just weren't in a position to borrow, so they couldn't roll over their commercial paper or whatever else, and that's forced them into liquidation of some sort, and that's forcing them to sell loans at perfectly good industrial credits at interest rates that in effect are so attractive that banks would be idiotic to make new loans instead of purchasing these assets. So the problem we've got is not simply that the banks are in trouble. The problem goes beyond that. The problem is that our economy is lubricated by lending, and a huge proportion of that lending has in effect come from non-bank institutions that operated at very high levels of debt to equity. And the result is that as the equity in those institutions is wiped out, every time you wipe out $1 of equity, you wipe out $30 in lending capacity. The ability of the market taken as a whole, non-banks and banks, to meet the demands of the of borrowers, both the existing requirements of borrowers and the potential future requirements of borrowers, that capacity has shrunken enormously. There is a huge credit crunch as a result. So whether one thinks that banks are nefarious or not, and whether or not one thinks that we ought to be, in effect, keeping our financial system alive, keeping the heart of the economy pumping, the reason why they're not lending is that to do so would actually generate more losses, or in effect delay the day when profits grow to such a level that they're able to sustain more lending. Because first thing we've got to do is absorb this supply, this oversupply of loans that are being sold by institutions being forced to liquidate. Anyway, I hope that's been instructive, helpful, useful, and comments from the many more educated or more knowledgeable readers of this blog are obviously more than welcome. I'm happy to stand corrected by some of our readers who have far more expertise than I do. All the best, and thank you for watching.